Hello and welcome to our new investment strategy update. Post-Iran conflict, investors are facing a very different economic and market landscape. Economies are still digesting an energy shock with its inflation and growth constraints. Oil markets have changed, but the impacts look globally manageable. The world economy has proved resilient, and if anything, the outlook has slightly improved. The US economy has been stronger than expected, supported by a stable job market. And as this is no longer a concern for the Federal Reserve, it can now focus more on price stability. Despite above-target inflation, we see Fed rates on hold throughout the second half, depending on how fast inflation declines. But without a doubt, rate hikes are more likely than cuts in the medium term. The capex cycle is still driving US growth, but real households' incomes are declining, and any new import tariffs would weigh on activity. These dynamics will all play out politically as we approach November's midterm elections. In Europe, governments are scaling back their fiscal spending, with EU funding winding down. Still, Germany's fiscal expansion should offset this to some extent. Meanwhile, political uncertainties in the UK will create some volatility. Across Asia and some emerging markets, strength in the technology cycle has offset oil market disruptions. China and Japan have used oil reserves and subsidies to shore up growth. Of course, the Middle East situation can re-escalate, but for now, our base case holds. We're in an economic expansion, and recession risks are low. This is a strong cycle driven by unprecedented investments as nations seek to ensure economic security and autonomy. And now, this recalibration continues through shifts in energy markets and technology. For Europe, that means a greater focus on domestic energy supplies and defense, while the US and China are locked in a race for technological leadership. Now, for market implications, let's hear from Luca.
A key pressure point in markets is easing. A recovery in Hormuz shipping is reducing strain on energy and other key supplies. As a result, oil prices, inflation, and bond yields will all decline over the coming months. For markets, monetary policy and liquidity should remain supportive. A normalization in interest rates and volatility will support equities. This creates favorable conditions for risk assets, and we maintain our pro-risk stance. In equities, we stay overweight. Earnings remain strong and continue to be revised upwards into 2027. So far, the rally has been concentrated in technology, with much attention on IPOs. But from here, we expect performance to broaden. After a strong run, the outlook for tech is more neutral, while cyclical sectors should recover. We favor financials alongside healthcare and utilities. So where do we see the strongest opportunities? Emerging markets continue to stand out. Earnings momentum is strong and valuations more attractive than in developed markets. While Korea and Taiwan have led performance so far, China has scope to catch up. In developed markets, we've increased exposure to US small capitalizations, which should benefit from resilient growth, lower bond yields, and attractive valuations. We keep our overweight in Japanese stocks, where earnings growth is strengthening. In fixed income, we have raised exposure to global government bonds to neutral, locking in high yields as price pressure eases. The most compelling income opportunities, however, remain in emerging market hard currency debt. Our holdings here mean our overall fixed income allocations are overweight. In currencies, a stable Fed outlook and a resilient US economy should support the US dollar. We therefore take a neutral view on the dollar against the lower-yielding developed currencies, such as the euro or the Swiss franc, while staying positive on higher-yielding currencies, including emerging markets. Finally, we keep our gold overweight, supported by solid structural demand, particularly from central banks. That said, with the Fed removing its easing bias, we've lowered our 12-month target to 4,800. Markets enter the second half of the year having absorbed a conflict, an energy shock, and inflation concerns. We remain positive on risk assets, but risks remain, including a more hawkish Fed, geopolitical tensions, and policy shocks such as tariffs. The environment remains volatile, but still supportive for risk-taking. We stay vigilant. Thank you very much for watching.